you can see in the titles of the two books, historical economic development. There was in the 70s, 80s, there was also this debate on between McKinnon and Shaw on the one hand and the so-called neo-structuralists, Van Wijnbergen, Otto and Solis. But it was really about developing countries. Now, what many people might not know is that two papers that kind of started the empirical finance and growth literature, King-Levine, 93 A and B, were actually part of a World Bank project on how do national policies affect long-run growth. And as you might know, obviously, the World Bank doesn't care about advanced countries. It cares primarily about developing countries, emerging markets. So again, it was really the focus was on developing countries. So I think it's important to keep in mind when we talk about this whole financial development and growth research agenda, it was really driven by the thoughts, by the ideas of what kind of policies do we need to improve growth in developing countries. And of course, this was also a little bit of a sea change. I mean, so Ross Levine always likes to remind me that back in the 50s and 60s, there was this idea, well, financial sector is not really important. Partly also driven by this Harrod and Doma growth model, constant capital output ratio. If you want to have more output, you want to have more growth, well, you just get a higher capital stock. And it means just pouring money into developing countries, not thinking about how it is actually being intermediated into real investments. I remember there actually was an interesting paper by Bill Easterly at some point where he basically showed that if the Harrod-Doma model would hold, or were to hold, then given the amount of money that flew into, I think it was Zambia, since its independence in 1960, Zambia would be as rich as Belgium nowadays, just based on how much money they would go into this. So again, this idea that the capital output ratio is constant, it doesn't matter how you get the capital, just money flowing in, that was clearly wrong. And that's basically where the whole idea of the financial sector development came in. Of course, also related to a later chief economist at the World Bank, a bit of a controversial one, Paul Romer, this whole kind of this new growth theory, not so much focusing on capital and on labor, but more focusing on productivity growth. Again, financial development being part of this agenda. So again, I'm saying this because I just want to set the scene and saying, well, if you talk about too much finance and we want to say, I see this as a counterpoint to finance and growth, it is really kind of almost a different conversation. So yes, financial repression, private financial markets. It's important to understand that the theory is actually ambiguous on whether finance is good for growth or not. There are actually theories that say no. It could also be if it's too efficient, there's not enough savings in the economy and so on. And this gives lower growth. But then the empirical evidence starting with King-Levine kind of clearly showed to a positive association. And I'm here still using the word association, correlation, partial correlation, because the causality part only came somewhat later. Maybe just very briefly, how can finance help? This is just a kind of a little slide I have here. So we can think about the individual level, and again, we can think about household, we can think about firm level, the different kinds of services that are good, that can be helpful on the individual level and on the aggregate level, and that's where financial sector development more focuses on. Increase of formality, efficiency through specialization, improving the resource allocation, allows entry, exit, competition, innovation, also reduces even discrimination. Actually, Ross has a paper on that, more level playing field. So all of these can be seen as positive things that the financial sector does and the overall economy, society-wide level. Now, starting with 2008, and not surprising in 2008, maybe a little bit before, there's of course also ideas, well, there might be actually too much finance. And I'm going to come back to this. Of course, we know that explicit subsidies, political encouragement of just pushing out credit, again, we saw it in the US. Shocks like the euro adoption, low interest rates, which then led to credit booms. Overexpansion beyond intermediation part of financial development, and then the brain drain, which I'm going to come back to later. So again, this is these are kind of different parts of the discussion, the conversation that we had over the last 20 years. Again, you can think about developing countries, especially the first part. In the advanced countries, we kind of give this as given nowadays, that we kind of benefit from all of this. aggregate level, can be throughout different levels of economic development. This one, maybe less so in developing countries, maybe it can be a little bit in middle income countries, but especially in advanced countries. So now, what I want to come back to, wait a moment, just let me just, yeah. Right. Yes, I haven't mentioned this, but of course, when I talk about association, there are these whole issues, the econometric issue, what we call the identification challenge. We talk about augmented variable bias. So is it really finance? Is it something else that drives economic growth? Reverse causation, demand driven. And that's the part I'm going to talk a little bit about, because that has been often ignored, is the measurement bias. Because what actually is financial development? And what I just, how do we actually capture the idea of an efficient financial system? If I were to go back to the previous slide, which I'm not going to do because otherwise you get dizzy. If you think about these different functions, be it payment, savings, credit services, or be it resource allocation, risk diversification, specialization, by King Levine, and then ultimately what most of us kind of have settled on, I think, including Hugo, is these private credit GDP, which is basically the total claims of financial institutions on domestic non-financial sectors relative to economic activity. So, which kind of says, I mean, again, it's total claims, but it's kind of seen as a proxy. How much credit? Well, it's not a proxy, but how much credit does the financial sector provide to the real economy in the country, in the society? And that's kind of seen, yes, as kind of capturing somewhat how efficient, how developed the financial sector is. But it's important to understand it's really very, very crude. It doesn't really capture the little details that we want to capture. How efficient is the financial system in providing these services in terms of the cost efficiency? How competitive is it? How inclusive is it? How diverse are the products that it provides? Is it all short-term? Are there also longer-term products? So it's how diverse is the financial system as such? Is it all just 5 banks, or is it banks, leasing companies, capital markets, pension funds, and so on? So all of this we'd like to capture with a measure of financial development, but we don't have it. So we basically go back to private credit GDP and kind of say, oh, well, that's what financial sector development is. So it is very crude, and I think it's important to understand, and it sometimes gets lost in the conversation, that there's not really a one-to-one mapping between this measure and the idea of a efficient financial sector. The other concern being that when we think about financing growth, we think about this long-term relationship. But of course, as we kind of do our econometric studies, and to increase the number the degrees of freedom, sometimes you go to shorter term periods. I mean, I've done it myself, let's say 5-year periods. Then the question is it really, if you see an increase in private credit GDP from one year to the next, is that really financial deepening, or is it just a credit cycle or the business cycle? So that's the other question. So there's a lot of things that I think we have to be careful about when we interpret both the measure, but then also the results of the regression where we use this measure in terms of the relationship between finance and growth. So the other important thing, and actually that's something that Ross, who also was my PhD supervisor, kind of taught me very early on. Private credit GDP, okay, so even if you think that financial development causes economic growth, so let's, for the moment, and I'll put this in quotation mark, financial development is not a policy variable. It's not to say, well, and I think that actually goes also back to something that people like to refer to as Goodhart's law. It's if you cannot just increase, let's say, private credit GDP from 20% to 30%, and then saying, oh, wait, yeah, now we're going to get more growth. It's the underlying policies that matter, how financial sector development develops and how it then can affect economic growth. So by artificially pushing out credit, you will not get additional growth, at least not in the long run. So that's the important message, the additional important message that comes out, and that goes back to what we said earlier. I think somebody mentioned this, that it's really about the translation of the research results into policy. Financial sector development, private credit GDP is not a policy variable. We have to understand what drives an efficient financial system. And again, the measurement error comes back in there again, because private credit GDP is a proxy measure. So there's an extensive literature, which I can't go through, that we think we start understanding what drives an efficient financial sector. The other important thing is that the economic growth versus stability. So again, we start with the idea that financial sector might be good for economic growth, at least in developing countries. And yes, again, coming from the regression results, private credit is a let's say again, be cautious, say it's a predictor of economic growth. We also know from a different literature that growth in private credit is a very good predictor of systemic distress. So the higher the growth in private credit, the more likely there will be a banking crisis a couple of years down the road. And again, this comes out of a different literature, the banking crisis literature. But as you can see, there's already here a a trade-off or a mismatch, so to say, between these two literatures. This has been at some point being connected. Some papers, I think one of the first one was Norman Loiser and Romain Rancière, that basically showed, well, yes, in the long term, there might be this positive relationship between finance and growth. In the short term, it's actually a negative one. So there's clearly a trade-off between these two. The important thing is, this is actually also consistent with theory. You can also say there's no free lunch. Two very specific things, Diamond and Dipwick. Banks as liquidity providers, liquidity insurers, makes them fragile. They can only fulfill their function as liquidity providers by being fragile. It's not a bug of the system, it's a feature of the system. And similarly, banks as intermediaries makes them susceptible to agency problems. Yes, again, no free lunch. So you have this trade-off being explicitly built into the banking sector and maybe also other parts of the financial system. So now I'm coming actually to the point of what I want to say. Too much finance, question mark. And given what I just said, I think there are actually three questions here. The first question, can there be too much credit? And that refers back to what I just said. Growth in private credit is a good predictor of banking crisis. And yeah, I think we can say so. And again, this can be captured by private credit GDP as a measure of credit growth. Can the financial sector grow too large relative to other sectors? That's somewhat a different question, because you can have a huge financial sector, but not much credit. Actually, one example I remember is Nigeria in the 1980s, financial liberalization, well, part financial liberalization, but they didn't liberalize it completely. They had still these multiple tiers of exchange rates, multiple exchange rate system. And then the banking sector basically got engaged in just arbitraging the exchange rate system. During this period, the following 5 years, deposit fell by half, credit fell, I think, also by half or even by more. But the financial sector grew like crazy. They doubled or tripled their employees. The number of banks went up. Why? Because the financial sector was just doing arbitraging of the exchange rate system. So it's clearly there's a mismatch here between financial sector development, and the financial sector as such. And finally, can there be too much financial development? Which again is yet another question, I would say, because maybe they become too efficient, or they provide certain things that maybe are not as that good for the economy. So yes, can there be too much credit? Yeah, absolutely. The boom-bust literature, financial crisis literatures, I think there is most people would be convinced by that. Can the financial sector grow too large? Yes, and I think we're going to hear later from Stephen and Anise on that. And I have a PhD student who also worked on that. Maybe I'll come back to this later. Can there be too much financial development? Well, yes, maybe banks get a different business model. They go beyond intermediation into all other stuffs, trading, corporate finance, crypto, who knows? There's an issue of financial structure. Do we have to write financial institutions? Going to come back to this in a moment. And then I'm going to talk a little bit about who actually benefits from the credit. And I think that's actually where, for me, one of the core questions of the non-linearities. So that's what I'm going to talk now, non-linearity. So, and I think the paper by Jean-Louis and Enrico and Hugo have really made a big contribution because they really focused our attention to the issue that, yes, there are non-linearities. Again, in the original finance and growth literatures, given that we focused on the developing countries, that was really the focus also from the policy side, we didn't really care about the top edge. Yes, we made these comparisons. If Peru had a financial sector development as Canada, how much more would it grow? But we didn't really care about Canada versus the US or Germany versus France. That wasn't really the focus of any of that. So I think it was important to understand what happens if the financial sector deepens beyond a certain threshold. Now, I think the more interesting question is, why is this the case? Why do we observe these non-linearities and maybe even negative relationships? Now, one early on paper here actually was, and I think they used actually the same data that we have, that we used, Philip and Aguillon et al., is saying, well, the financial development can help reach the frontier of productivity, which is typically seen as the US, but it can't really go beyond that. So the financial sector helps reduce growth constraints as long as you push to the frontier of productivity. Once you're there, you need something else. You need, I don't know, innovation. You need the real sector has to kick in, basically. Another observation was that especially in advanced countries, banks are going into non-intermediation business lines. I mean, of course, not just in advanced countries. I just mentioned the case of Nigeria. I'm going to talk a little bit in a moment about the concept of financial system, and then very important, who gets the credit, households versus enterprises, or non-tradable versus tradable sectors. So the first thing, very briefly, yes, I think I'm doing fine. And I'm going to now talk a little bit also about my own work. I'm just going to abuse my privilege of standing here. One thing is the financial structure, and this observation or this kind of work goes back to the observation that in Europe, especially in Europe, we have these so-called bank-based systems, where the banks really, well, not as much anymore, it has kind of come down, but until recently, really the banks dominated the financial system. Now, banks have a very specific business model. They really rely on lending based on tangible collateral. And you can show this theoretically, and you can also show it empirically. They're not really in a good position to fund startups, to fund new young firms that don't really have any collateral, that don't really have any track record. And that also means that in specific sectors that rely on intangible assets, let's say IT, that rely more on intellectual property, they're not really the ideal funder of such firms. And this is basically what we show in this paper, where we show that we use a different measure of banking sector development, which is liquidity creation, which is the transformation of liquid liabilities into illiquid assets. That this is, yes, it is related to growth, but it is only related to growth in tangible assets, tangible capital, not to intangible capital. And as economies kind of shift from a kind of sector composition of heavily manufacturing, producing stuff, to a economic model where it's mostly about intangible, about ideas, the banking sector doesn't really contribute to growth. It's not necessarily something bad, but it doesn't really contribute to growth anymore. And so what you see here is this blue line is the kind of the growth effect of liquidity creation. So the significant bands around it, and then here on the horizontal is the share of intangible assets in an economy across kind of built up or aggregated across different sectors. So we take like saying sector A has on average so much intangible assets compared to tangible. Sector B has so many intangible relative to intangible assets. And as the overall ratio of intangible assets to tangible assets goes up in an economy, given the sector composition, the growth effect of banking sector development basically goes down to zero. It turns negative, but it's not significant. And that's kind of one explanation again why we don't observe any growth effect of financial development on economic growth, especially in Europe, given that our economies rely more and more on intangible assets, and given that the European financial system is so heavily bank reliant. Of course, you can also take a positive message out of that and say, well, we need other types of financial intermediaries, venture capitalists, angel financiers, equity funds. We come back to a problem. We typically do not capture them in our financial sector development indicators. That's yet another measurement issue. So, what kind of financial sector? Actually, just before we started, we had this discussion over there at our table about value added of the financial sector, and that actually is an idea that came to me when I was working here in London, and I realized that when we academics talk about financial sector development, we talk about something very, very different than when people in the city or even in the Bank of England talk about the financial sector, because they talk about how many people work in the financial sector, what is the value added to GDP. And that's not really what we as academic, or I guess most people in this room, think about what the financial sector is actually supposed to do. We think about the financial sector as kind of a meta sector that supports the rest of the economy by intermediation services. And that's different from what we can say financial center view, we call it, where the financial sector is one out of many sectors, and by just increasing its share of GDP, you also grow faster. And I mean, that has been partly behind the idea of London as a financial sector for many years. It's not just about people working directly in banks, investment funds. It's also the accountants, it's the auditors, it's the legal services. So it's the whole kind of ecosystem around the financial sector. These people are highly paid, and that's why I often say, well, London contributes so much to the GDP of the UK because it's partly because of the financial sector. And you want to foster this maybe with regulatory policies, subsidies, and so on. Again, very different views, I would argue, because I wouldn't necessarily say that the financial system of the UK as such is so much more efficient than, let's say, the Dutch financial system, the German financial system, or the French financial system. I would argue maybe a little bit, but it's definitely not when you compare according to value add. So what we did is a very simple paper, which I did with Hans Reese and this is the typo, Christiane Kner, who's now at the Bank of England. We kind of compared, this is actually the graph for the UK. This year, the red line is private credit to GDP. It's in logs. That's why you have these weird numbers here. But as you can see, it's kind of has increased. So this ends in 2008, I think. This is the sample. So slow increase in private credit to GDP in the UK. And then you see the value added to GDP in the UK between 6-9%. It jumps quite around actually. It's of course, again, there's a measurement issue, I think, for value added in the financial sector, but we get very similar results when we use employment. What we find, and again, these are very simple regressions. I wouldn't really contribute causality here. Yes, I mean, maybe not surprising in our sample, which is actually more dominated by advanced countries. We still find that in the long term, which I think is more than 5 or 10 years, we get higher growth, low volatility from higher intermediation, as we call it, private credit GDP. Size, value added to GDP, or employment share in total employment of the financial sector. Size, yes, it can come with higher growth, but it definitely comes with higher volatility in high income countries. And maybe that's not surprising. I mean, I think the UK has seen much more volatile growth than many continental countries. Now, of course, there are many other reasons. I mean, it's a small open economy and so on, but well, I shouldn't say small, but it's a very open economy. But I think maybe other examples which are not in the sample because it ends in 2008, think about Iceland, which tried to build a financial center and it went horribly wrong. Had very, very volatile GDP, not to say it had a big crisis. So again, I guess the argument coming out of this work, and it comes back to what I'm going to talk about in a moment, is that if you think about the financial sector as just a sector in terms of its size and contribution to GDP, that doesn't really imply necessarily more long-term growth. Yes, it doesn't mean it's bad. It's the question: does an economy want to specialize in financial services? And there might be a case. I mean, I can think about Mauritius, for example, which is this British-French legal origin country, the bridge between Africa and Asia. There might be a case to be made, but you couldn't. The effect on economic growth is definitely not the same that we think about when we talk about financial sector development as such, an intermediation efficiency. Yes, and actually this comes back to, I guess Stephen and Lisa are going to talk about this later, but also Christiana has this paper on brain drain, basically. This was the time in the mid-2000s when all the MBA students and the PhDs, the MBA students went to the financial sector, and the PhD students in the hard sciences went to the financial sector instead of contributing to the real economy. Yeah, a brain drain from a too large financial sector, taking skilled people away from the real sector. So the final point I want to make is about who gets the credit. Again, if you go back to theory, the 80s, or the concepts of financial sector development, we think about this entrepreneur with great ideas, no money, savers with lots of money and no ideas. And how do you get money from the savers to the entrepreneur? And by funding innovative entrepreneurs, you get more growth. That actually, in one of the papers by Bob King and Ross Levine, they actually have a small model that kind of models that actually. So that was the original idea of financial sector development and its impact on economic growth. Now, the reality, especially in advanced countries, is a very different one. What we have is firm credits having increased, but then kind of actually stabilizing, like after the 90s, even actually going down a little bit, but kind of stabilizing. And a big chunk of what you could say the increase, I wouldn't call it financial deepening, but the increase in private credit GDP was really an increase in household credit. And of course, that was primarily mortgage credit. And if you look at countries, let's say Denmark or Netherlands, I think by now it's 70-80% of bank credit that goes into household credit. Even beyond that, if you also look at within enterprise credit, you see that more and more goes into construction. In so-called, and we'll call them the non-tradable sectors. So less and less goes into manufacturing, which are kind of tradable sectors. So more credit to households rather than firms, mortgages especially, or consumer credit in many developing countries, much less and less credit into tradable sectors such as manufacturing. You could argue, well, maybe it's because they get credits, they get funding, external funding somewhere else. But let's say in stock markets and capital markets, I'm somewhat doubtful. Of course, it might also partly reflect the change in economic in the sectoral composition of economies. But that's so I'm not saying there's necessarily a causality here. Although there is some evidence, I'm going to come back to this in a moment. Actually, let me come to this first. There's an interesting paper on the US, which basically said that if looking at US banks that are relatively more active in housing markets where you have strong price increases, or you had strong price increases before 2005, that's also where they reduce the commercial lending. So basically, housing markets, housing mortgage loans crowding out commercial loans. And then this has, of course, knock-on effects for the real sector. So there is actually some evidence that having these housing booms might actually crowd out credits to tradable sectors. Now, again, we do a very simple cross-country regression on enterprise versus household credit. We get to the results that the financing growth relationship is driven by firm credit, not by household credit, which then, of course, might again explain the nonlinearity. If most of the credit in advanced countries, or the additional credit in advanced countries as reflected by private credit GDP, and as you can see here, is to households, then you wouldn't expect any growth effect from that additional credit. So that might partly explain the nonlinearity, not completely, but might part of it. Right, so there is some interesting work, which I'm going to briefly mention, by Carsten Müller, by whom also this previous slide with the data came from, and Emil Werner, just recently published. It's not just about this non-tradable credit not necessarily being irrelevant for economic growth. It is actually also that it can be bad for credit cycles, for credit boom and bust cycles. And again, here there are just a couple of examples. 3 of them are from the Euro debt crisis. One of them is earlier from Japan, where basically the credit boom, which 30 years ago we would have called financial deepening, now we call it credit boom, is really driven by credit to non-tradable sectors. And yes, you had short-term growth effects, but then of course you also had very negative effects after the boom turned into a bust. Now, is all hope lost? No, they have one nice example here, Korea, the Korean growth miracle, where basically this was also a credit boom / financial sector deepening, but there the credit actually went to manufacturing. Now, of course, that's a much different period. It was the 60s and the 70s. But so, yes, I think it's really important to understand if you see, let's say, this increase in financial sector development / private credit GDP, what actually is behind it? What drives it? And again, it can, if it's tradable sector, if it's manufacturing, it might have a very different effect than if it's purely household credit or credit to non-tradable sectors. So I think I'm done. Let me just very briefly go to my conclusions. So first of all, I think the one point I really wanted to make is that when we talk about too much finance, you really have to make sure we make clear what we mean by finance. Is it pure credit? Is it the financial sector, or is it financial development? And we basically use one variable, private credit to GDP, for all three. But we have to kind of dig deeper and think, what actually do we mean by that? And I think it's partly also a conceptual debate. Yes, growth versus stability, you can't get one without the other. I mean, there's also this very interesting paper, again, Romain Rossier is involved, but it basically showed they have this comparison, India versus Thailand, where India had very slow, very low financial development over time, private credit GDP, but also didn't have any crises. Well, actually not, we had some crises, but not as many, not as big crises as Thailand in 97, where Thailand had a much more rapid financial sector development, higher growth, but also crisis. But ultimately, the growth was higher in Thailand than in India. So there is definitely a trade-off that we have to think of. And again, it's a feature of the system. It's not a bug. So yes, and now I'm coming back to the initial question, too much finance question mark. Yes, there can be too much finance. But I think the more interesting question is why and how. How do we think about it, and what does it mean for policy? The very last point, and I think that's also maybe also a little bit kind of a humbling point. I mean, having worked on this now for what, 25, 28, almost 20 years, I think we keep thinking I think it's important to keep an open mind about how we see the financial sector. And we also seen over the last 30 years very different developments in the financial sector. And yes, the facts can definitely change. The financial sector looks different nowadays than it looked in the 90s, than it looked in the 60s. And we might have another kind of big change with crypto coming in, stable coins. So again, it's important to keep an open mind. And I think that's the most important point maybe that I want to leave you with. Thank you very much.
We're a little behind time, but that's our fault. So can we have perhaps 2 or 3 questions? And I would say we're aware that we have slightly too many men in the speaker list. So I would prioritize questions from women, and we should probably do that through all the sessions. So please. Jayati.
As a woman, let me. Thank you. That was really interesting and fascinating, and I agree with everything. The one, I mean, actually, just want to pick up on 2 things. One is your Korea slide, which is very interesting because it ends in the 80s. So the 60s, 70s, and 80s are periods of state-directed finance.
Yes.
And that's why it was so successful. And once you have the Korean, I mean, you have the Southeast Asian crisis, and state stops directing finance, you get absolutely the opposite results. So I think that institutional thing, I think, possibly needs.
Okay, no, thank you for this. So number one, it's not my slide. It's actually from Carsten Miller. But it's a very valid point. No, maybe I should give a little bit more background. So what they do in this paper is they look at episodes. So they don't pretend to look at 30, 40 years. They say, well, they define a credit boom with a certain growth of overall credit. And that's something we observed, of course, in these countries, or including in Japan, and we observed in Korea. So that's why they basically said, we look at these, I guess the boom started around 64, 63 or so, and then we look at these 20 years. So they don't pretend to look at 40 years. Now, what happened afterwards, I agree with you, that's, of course, a very different story.
But the same story as the earlier slide. It's the same housing boom and bust.
Yeah, but then for me, the question would be, what kind of credit was it afterwards? Was it still manufacturing, or was it something else? That I don't know. That's so that's why I'm saying it's a kind of focused, time-wise focused issue. The other point that you made, and I think that is also very, very important, I haven't talked at all, and I know that Hugo has a view on that, who provides the credit, not who gets the credit, but who provides it. State-owned versus private versus foreign and so on. That's another question that I don't want to answer now, but I think that's also another debate we can have. So I agree. Thanks.
Any more for any more?
If there are no women, I have a question. A comment, but so I have a quick comment. So when we think about the channels where there can be too much finance, so I always think of three, and you discussed two of them. One is the one explored by Stephen Ennis, and Christian, which is the misallocation of talent. It goes back to the Tobin paper in the Lloyd review. Then there is the financial crisis. But one that I'm getting convinced is more and more important is the political power. So I live in Switzerland, which is probably like the country with the best institution in the world. And when you talk with people about the Credit Suisse disaster, they say, we knew everything, but every time the regulator tried to open their mouth, they just shut them down because these guys are so powerful. And I think this is really so this is the story of the quiet coup of Simon Johnson and everything.
I agree.
So I think that's very, very important, and that's under researched. I think.
So I had it somewhere in my very early slides. I had a mention of political economy, and I think that's absolutely true. And actually, it happens on every level. I mean, people always say, "Oh, the cajas in Spain." Well, I always like to say, for every caja in Spain, there's a Landesbank in Germany. So it's not even within Europe, you have this nice, pretty much everywhere, right? And I mean, so there's this very interesting paper. I forgot who's involved in this. I'm blanking out right now. But that basically shows how the political connection between Sparkassen, the small savings bank in Germany, and the local politicians actually caused both failure of such savings banks, which you typically don't hear about because they are small and they're being taken over by the association or by another savings bank. How the political connections between the local politicians and who sit on the boards of the savings bank kind of not just cause bank failures, but also then drive a little bit both the credit growth and also when actually the savings bank gets into trouble. And it's typically after election, not before an election, not surprisingly. So the politics, that would be another half an hour that I could talk about. There's a lot, I agree with you, there's a lot to be said. I mean, and actually even now, if we go to a very different topic, banking union, savings investment union, I mean, the biggest hurdle for me is always the national politics, right? As long as you don't get national politics out of it, you're never going to get to that. And that's talking about finance without the P word, the politics, I agree with you. That's an important part of it,
I'll do it. Just a comment to the comments. It's a meta level. In a sense, I get the channel is very convincing, but at the same time, it's not necessarily just about finance sector. So this can be applied to any kind of sector. When there is concentration of power, all of a sudden can affect regulations and toward maybe rent-seeking type of things.
I mean, I remember just to say that having grown up in West Germany in the 70s, West Berlin was famous for having the problem in the construction sector because, West Berlin was an island within East Germany. There was limited land and there was an enormous connection between the construction sector and the politics. There were always scandals. I mean, again, it's all historic now, but I mean, so that on the one hand, I agree with you. It cannot just be the financial sector, it can also be other sectors. But I think the financial sector is more prone to that. Why? Because it's easy. Right, because you want to spend money as a fiscal authority. Well, you might not have enough money. You might not want to have to go to the debt markets. Well, you can just tell your banks to lend more. I mean, these are fiscal liabilities, but they're contingent in the future. That's for the next government. So I think the financial sector is always easy. It's an easy solution for any government to be used. So I think that's why the politics is even stronger in the financial sector than in other sectors. I would argue.
We have a lot of time ahead of us, but let me thank you for a great overview of that. It's really interesting to see how quickly we've gone to the politics and the questions of capture, and I think we will be back here in a lot of sessions from now. So for now, Thorsten, thank you very much.